The average American carries over $6,000 in credit card debt. But here's the part nobody talks about. That number is not a mistake. It is not bad luck. It is the intended outcome of one of the most perfectly engineered psychological traps in the history of modern finance. And the worst part? You probably think you are using credit cards responsibly right now. Think about the last time you swiped your card without thinking twice. Maybe it was dinner. Maybe it was a flight you told yourself you needed. Maybe it was something on sale, a deal too good to pass up. That feeling, that frictionless, painless transaction, it was designed in a lab. Because here is the uncomfortable truth about credit cards in America. They are not financial tools. Not really. For the majority of people using them, they are a slow leak, a quiet drain, a mechanism that transfers wealth from the people who cannot afford to lose it to the people who already have more than enough. The United States has the highest credit card debt per capita of any developed nation. In 2024, total revolving credit card debt crossed $1.3 trillion. And while the Federal Reserve raises interest rates to cool the economy, credit card APRs quietly climb to an average of 27%. More than a quarter of your money, gone every year just for the privilege of spending money you did not have. And yet nobody feels like they have a credit card problem. Everyone thinks they are the exception. Here is how the machine actually works. When a credit card company approves you, they are not doing you a favor. They are making an investment. They have studied your credit score, your income, your spending patterns, and they have calculated exactly how much money they can extract from you before you default. You are not a customer. You are a revenue stream with a face. The business model is elegant in its brutality. They offer you a card with a $5,000 limit, a shiny rewards program, maybe some cash back on groceries. The limit feels like freedom. The rewards feel like a deal. You think, I am smart. I pay it off every month. I am getting free points. But the banks already know what behavioral economics has proven for decades. When you pay with a card instead of cash, you spend between 12 and 18% more. Every single time. Your brain does not register a card swipe the same way it registers watching physical money leave your hand. Cash creates pain. Cards create numbness. And numbness is profitable. Now add the minimum payment structure. This is where the machine becomes almost predatory. You carry a $4,000 balance. Your minimum payment is $85 a month. That feels manageable. That feels responsible, even. But at 27% APR, you will take over 5 years to pay that balance off, and you will pay nearly $2,800 in interest on top of it. That $4,000 purchase becomes a $6,800 purchase. And the bank did not have to do a single thing except wait. This is not an accident. The minimum payment was specifically designed to keep you in debt as long as legally possible. There were actually debates in Congress about this decades ago. And still, the structure survived. The deeper question is, why do intelligent people keep falling for this? The answer is psychology. And the credit card industry has spent billions studying it. First, there is the identity trap. Credit cards have been culturally tied to status, travel, achievement. A black card signals success. A premium rewards card signals financial sophistication. Nobody aspires to use a debit card. The marketing has quietly convinced an entire generation that debt-funded consumption is a personality trait. Second, there is what behavioral economists call hyperbolic discounting. It means your brain is wired to overvalue the present and undervalue the future. When you buy something today and pay for it later, your brain experiences the reward now and delays the cost until it barely registers. The pleasure is vivid. The interest is abstract. Third, and this is the one most people never see coming, rewards programs are designed to make you spend more than you earn. The math almost never works out for the consumer. The average cashback rate is 1 to 2%. The average overspend triggered by reward-seeking behavior is significantly higher. You are chasing $1 while handing them 10. The wealthy use credit cards differently. And that distinction matters. For someone with real financial discipline and genuine wealth, a credit card is a 30-day interest-free loan with insurance protection and fraud coverage. They charge everything and pay in full without exception. They collect the points and they never give the bank a single dollar in interest. But that requires a specific financial psychology, one that is rarely taught in schools, rarely modeled in households that grew up without money, and almost never reinforced by the culture around us. The system does not fail the poor. It was built with them in mind. So, what do you do with this? The first shift is understanding that credit is a tool with a razor edge. Used wrong, it cuts you. Used with precision, it can work in your favor. But most people are not in a position to use it with precision, and the honest answer is that if you carry a balance, the card is winning, not you. Start by knowing your real number. Sit down and calculate the total interest you have paid in the last 12 months. Not the balance, the interest. That figure will change how you see every future purchase. Second, stop treating the credit limit as available money. It is not your money. It is borrowed purchasing power that comes with a price tag attached to every dollar you do not pay back immediately. The limit is not an invitation. It is bait. Third, build what financial psychologists call a friction layer. If a credit card removes friction from spending, you add it back manually. A 48-hour rule on any non-essential purchase over $100. A monthly spending review where you face the numbers without looking away. These small resistances protect you from the automated impulsive behavior the card was designed to trigger. Fourth, shift your wealth-building focus from consumption to accumulation. The wealthy do not get rich by earning more and spending freely. They get rich by earning, keeping more of what they earn, and deploying that capital. Every dollar you lose to interest is a dollar that cannot compound in your favor over the next decade. The goal is not to never use credit. The goal is to never be used by it. There is a reason the credit card industry generated over $150 billion in interest and fees from American consumers last year alone. That money came from somewhere. It came from paychecks, from savings that never grew, from retirements that started too late, from people who believed they were playing the system when the system was playing them. The trap is sophisticated. It is colorful and rewarding on the surface, and quietly devastating underneath. And it works precisely because it never feels like a trap. It feels like convenience. The most powerful financial decision you can make is not about what you invest in. It is about understanding who profits from your ignorance. Because once you see the machine clearly, you stop feeding it. Money does not care about your intentions. It only responds to your behavior.